Hello, everyone. This is Osama Rizvi, and welcome to another episode of the Monday Macro View. The global economy seems to be on the crossroads of geopolitics and political decisions and other things like that. And we have been seeing some mixed signals across the world in the form of different economic indicators. There are also many important things, developments happening in the oil market. So I thought today we will take a deep dive into the oil markets and recent developments, and also a little bit about the global economy and where do we stand in terms of the recession. So if you look at the first slide here, you see that the Russian diesel export ban is in the news these days. And there was a really interesting article in Vortexa. Highly recommend them for tracking global oil flows, crude flows, and distillate flows. And you see that in this chart where it shows that Russian diesel exports on monthly basis had begun to decline slightly. But it is already before the export ban was announced. But this was because of the maintenance issues and refinery maintenances, and now we see that the Russian diesel exports, the peak in March 2023. However, now uh, before we have a look at what was the implication of this export ban moving forward, it is important to note that the Russian diesel exports have soared 15% higher between January to September 2023 as compared to January September 2022 last year. Now, after the announcement has been made, you see here, this shows the Russian diesel loadings on a daily basis, and they have slowed down significantly. The next slide shows the Russian diesel arrivals to EU and UK. And you see that there is a huge implication for Russia itself and these countries as well when we talk about the diesel export ban. If it is imposed properly, as we've started to see that it is already happening, Russia supplied about 40% of diesel to Turkey, and India at second with 20%. However, recently in the past 9 months, this share jumped to 80%. And if the diesel export and this diesel was being resupplied or reshipped to Europe, so the whole supply chain was still intact. Only the point of origin was different. But now, if this happens, Turkey will need to find other players, other resources. India will also need to do the same. Brazil will also feel the pinch because after March, 50% of the Brazil diesel import came from Russia. And this can create a huge issue for Russia itself, as a wartime economy needs continued cash flows. So if this happens, they will lose a lot on the cash flows. We'll see. Time will tell what will happen in this regard. Moving forward, if you look at the oil markets as a whole, we have seen the prospects of $100 oil seems quite bright, but I maintain that this would be temporary and that oil prices will take a plunge before the year end. I say that because we have been talking a lot about where do we stand in terms of the global economic indicators, and I'm not convinced, and we will see. If you look at the global economic indicators, global PMIs and other indicators, they are still not there, and they still do not support this sort of pricing that we are seeing right now. So a lot of sentiment is here, a lot of geopolitical risk premium is here, and I think it will dwindle, or it will, sort of chip away gradually. The 6-month calendar spreads were at $4 September 1, and now they stand at 10, hinting backwardation. Moving forward, if you look at the second slide, you see that the commercial oil inventories at Cushing have been at the lowest point. You see here at the right corner of this chart, at the lowest point since 2008 and since 2014. And the prices at that point were about 140 or 121 barrel, respectively. The inventories here in US have depleted. Very interesting. Have depleted faster than inventories anywhere else. And I mean, the Cushing inventories account for only about, I think, 10% of the total inventories. But their weightage on the market sentiment is quite strong, as we are seeing right now. Something related to it and why oil prices are rising, the rally is still holding because of one of two factors. One is the fall in Cushing inventory. Second, is the prolonged cut by Saudi Arabia. And we're seeing here another chart by Votexa. You see here that OPEC exports have been fairly stable throughout the first 24 days of September. However, but now, as of today, we have finally started to see that the arrival levels have been started to hit in the consumer markets. And if you look at the first 24 days of September, 25.5 million barrels per day of OPEC plus crude and condensate arrived in importing countries, which was down 1.5 million barrels per day from August so far. So I think a very important question is that how long will this continue? I think at some point demand destruction will settle in. And given the overall scenario of the global economy, the orientation of the global economy, I believe as soon as we hit $100, we'll start to see diplomatic pressure building upon Saudi Arabia, because the $4 in the US, prices at pump have already breached the psychological mark of $4 per gallon. And I don't believe that the current administration, or any administration for that matter, would take it really lightly if the prices continue to increase. This will also have a negative effect. It's sort of a setting up a negative feedback loop if these prices continue to rise. So I believe in the near future we will see the production cuts unwinding at least a little bit. Also for Russia moving forward, they have also imposed a diesel ban. So the important point for thinkers and observers and policymakers and traders is that how long will Russia be able to go along, tag along with OPEC, with Saudi Arabia in its pursuit of higher oil prices and production cuts? So Saudi Arabia would at some point would need to increase production to balance their economy. Sanctions have had somewhat effect on Russia as well, and they would naturally need more money. Moving forward, just wanted to show two of the economic indicators. We will talk about them in detail next week. So global PMI still below 50, anything below 50 hints contraction. We haven't seen it's recovered to the levels you can see here in 2021 or before that. So it has a long way to go. You see German IFO, I focus on Germany a lot because it's quite a very important economy in the Eurozone. And you see that they're also not doing really well, as you can see clearly from this chart. You'll move on to the market sentiment tracker, and you see that the left side, the recessionary side, continues to build up. I think all the key measures highlight heightened risk of a recession. Global PMI is below 50. Japan's PMI is below 50. Chinese PMI is below 50. Japan's inflation remain high. The core inflation, UK money supply, interestingly, fell for the first time in 13 years. That is very important. And London office vacancies hit 30 years high, sort of a rental recession happening there. So that's all from today. I think this gives us a very clear overview of what's happening in the oil markets and what to expect. I'll be back with more interesting stuff next week. Thank you so much.